Hello, everyone, and welcome to our webinar today. Today, we're going to go over cost of goods sold and the various items within cost of goods sold. My name is Steve Hovland. I'm a CPA and a certified forensic accountant, as well as the founder of Delegate CFO. Thank you for joining us. Before we get going, we need to take care of some housekeeping items. The webinar will be about 40 to 60 minutes long, depending on questions and how many questions we get. This webinar will be recorded, and after the webinar is over, we'll be sending out a recording as well as the slides. If you're watching this on replay and you want the slides, please email us, and we will get those slides to you as quickly as possible. Also, please use the Q&A function within Zoom to ask any questions. One caveat, when we've done this presentation before, we sometimes get questions where we have to do more than just a verbal response to the question. Many times we have to do a formula or kind of walk through a formula with somebody. If those questions arise, we may not answer those during the webinar just because they tend to take up so much time. So if you do ask that particular question, don't fret. We'll get with you offline and kind of walk you through that. I just want to let everybody know that some questions will have to be answered offline as opposed to going through and answering them verbally, just because they require a little bit more than just kind of a verbal response on that. So with that, let's go ahead and jump into our webinar. Again, we're going through understanding the cost of goods sold, materials, labor, overhead, and break even. And even though it's a big title, all those items really intertwine with one another, and especially they intertwine and have a significant impact on that last item on break even. So today's agenda, obviously we're going to do an overview of cost of goods sold. We're going to go through materials. We're going to go through safety stock and order point, direct labor, overhead, and then of course getting down to the break even. Now, it's important to note that cost of goods sold on a very simplistic level is really just going to be your material, your direct labor, and your overhead. Those three items combined together, for the most part, make up your cost of goods sold. And as we've kind of discussed before in previous webinars, the formula may be simplistic, but what goes into it can change and have a significant impact on your financial statement. So let's go ahead and jump into the respective session. So what is cost of goods sold? Well, in a nutshell, cost of goods sold is the direct cost attributed to producing goods sold and or products, or I should say services, um, performed for your customers. It's really any cost. The best way to think about it is it's any cost that goes into selling that product. So if you sell a widget, everything that goes into getting that widget from raw materials to ready to go on the shelf and hand to a customer to be sold, every single one of those costs that go into getting to that point, whether it's direct or indirect, is really what should be considered cost of goods sold. Now, from a financial standpoint, cost of goods sold is almost always going to be a separate line item on your income statement. So on your income statement, you're going to have top line is going to be revenue. Next line is going to be cost of goods sold. Then you're going to have your gross margin. And then down below that will be all your operating expenses, which are your sales, marketing, admin, so on and so forth. It's important to note that the cost of goods sold, it significantly impacts your gross margin and your profitability. The reason being is, if you recall last week in our gross margin webinar, where we talked about the formula for gross margin is revenue minus cost of goods sold equals gross margin. Your cost of goods sold will obviously impact that gross margin, because the higher that your cost of goods sold is, the lower your gross margin. The lower your cost of goods sold, the lower your margin. It's also important to note that understanding what is in your cost of goods sold can actually significantly impact your profitability. And the reason being is, obviously what we've seen here is, cost of goods sold is a part of gross margin. But if you don't have an accurate or a firm understanding of what's in your cost of goods sold, it's very difficult to, one, have a proper sales price for that particular product, in which then that obviously trickles down to net income, and it's difficult to become more profitable or even be profitable if you don't have a firm understanding on what is actually in your cost of goods sold. So again, why is it important? It's essential for pricing and profit analysis. Most of the time, when you're trying to determine what you should sell your product for, you're going to use how much does it cost first, and then from there, I'm going to determine what my sales price should be. And in this particular situation, the if you don't understand what your cost of goods sold is, you're going to probably incorrectly price your product, which then, of course, leads it down to incorrect profit analysis. Kind of a real world example, we had a client several years ago who came on with us, and they had been in business for quite a while. And in their cost of goods sold, so they did a gross margin on all the products. So they had revenue minus cost of goods sold. Here's the gross margin. And that was kind of the driving point for their sales price for their different products. And we realized when we started looking at their analysis that in cost of goods sold, they only had materials. They didn't have any labor, and they definitely didn't have any overhead. And so when you looked on the face of just sales price minus materials, yes, they had a positive gross margin, but they were confused as to why they weren't really pulling in a decent amount of net income every year. Well, it turned out that when we went through and added in direct labor and overhead into their cost of goods sold, which it should have been, some of those products they were actually selling at a loss. I mean, their margin was actually negative on that. And so that's why it's essential to understand what is in your cost of goods sold, so you make sure you're selling it properly. And then, of course, that ultimately goes down to your profitability. Because if you're not selling at a proper price, you're not selling it high enough, you're ultimately taking that money out of your bottom line on that product. And so that's key to that. And again, it helps if you understand what is in your cost of goods sold, it then helps you truly understand what you need to sell that product for and what or service. Even though we're talking about cost of goods sold and we'll talk about specific physical products, this also trickles into service industries as well. It's just in the service industry, your main cost of goods sold is going to be the salaries of your professionals or the individuals that are helping provide that service. So material cost definition, obviously raw materials or material cost is going to be raw materials and components to in the finished product. Examples is, of course, wood for furniture, flour for bakery, chips for electronics. It's important to note in here that on your material costs, if you see in that definition where we talk about raw materials and components, obviously raw materials is kind of a no-brainer on that. If you're building let's say you're building an amusement park ride, and you have to bring in all sorts of steel and aluminum as raw material, and then form and weld and put it together onto the respective ride, that's kind of a no-brainer. But your components, so if you have to get a hydraulic motor and put it on there, but you don't actually build the motor, you buy the motor from somewhere else, that's still a component, that's still a material cost of, in this case, the amusement park ride. And so it's important that when you're looking at your material costs, you're also bringing in all the other items that you have to put on that respective product. It's still a physical material on that. It's not just raw material. It's everything that actually goes into that. And then the other aspect on material cost is, especially obviously if you're making physical products, you need to track waste, obviously spoilage, and price changes. Waste is one of the more difficult items to accurately track. And an easy example of that is, say you buy an 8-foot by 4-foot piece of steel, and you have to cut out specific parts for that piece of steel. Most of the time, when you get done, you cut out all the parts, there's going to be a leftover parts of that steel, just the outside of the template that got cut out. That technically is waste, because you can't reuse it, you can't cut any more pieces out of it. And so that's part of the waste. And so that's part of the items that you need to track and build into your respective calculations. Now, the reason why I say that that's one of the more difficult ones is true waste tracking will dovetail into a true cost accountant role. And so just so you know, in the accounting world, cost accountants are actually one kind of branch in the accounting world. You know, you've got a tax accountant, auditor. Cost accountants usually another branch because there's a lot of formulas and understanding of how things go back and forth. So not all accountants can do cost accounting, is where ultimately what I'm saying on that. Spoilage, again, similar to waste, but spoilage is usually going to be, for the most part, on durable goods. You know, so again, in that example you see up above, where we talk about flour for bakery, you know, if you're grinding your own flour, you know, you have the wheat berries, you're grinding them. Usually, it's been said that you know you can only keep that for about 5 days, and then after that, the grinds that particular flour goes away, or is not really viable anymore. So that would be spoilage. So similar with any product as well. So if it gets hit with UV light and it can't be used again, it's more or less it's been spoiled and or obsolescence. And then the other thing is price changes. And the key part on that is if you're buying from suppliers, you know, supplier A and supplier B, and A is where you normally get whatever the particular product, raw material product from, but they're out of it and you need to fill this order, so you get it from B. And let's say their price is a little bit higher. You need to be able to account for that price change. You know, is it a temporary price change? Is it going forward going to be the same? So you need to make sure you're accounting for that. And we've got a question here. Are packaging and shipping materials included in material costs? Well, that depends on what we're talking about here. And that's the unique thing about packaging and shipping is general rule of thumb is if it's to bring the material in and or get the material ready for the final sell product, then it would be considered a cost of goods sold. If it's to ship it out, in other words, put it into an Amazon box and ship it out, that's a selling expense. That's not part of your cost of goods sold. And so you need to kind of track as to where in the process those costs are incurring with that product. So in other words, if you have a widget, but you've got to put it into, you know, a fancy little box that has all the advertising on it, but it has to be in that box before you can physically hand it to the customer, then yes, that's part of the cost of goods sold. That is part of your material costs. Next part, safety stock and order point. Now, these are important, and you may be wondering why we're talking about this when we're talking about cost of goods sold. These actually come into play both on the cost of goods sold and on the respective break even. So safety stock really is just extra inventory kept to prevent stockouts. So in other words, you always have that safety amount sitting there while you got to, you know, you wait for your next order of raw materials to come in. You still have inventory sitting there, and you have that wiggle room to be able to service the customer and not, you know, all of a sudden run out of raw materials or run out of materials to make the product. And you have a customer that has a sales order, you know, and you run into that danger of them going to another particular competitor of your organization. So that's the key part on safety stock. Now, order point, you know, safety stock ties back into that. You know, the order point is the inventory level that triggers new orders. This ensures that materials are available for production, balances cost of holding stock with risk of running out. And so the formula there is obviously order point equals average daily usage times lead time plus safety stock. So what that formula means is your average daily usage. The best way to think about it is what's your average daily sales. You know, sell 50 units every day type situation. And then your lead time is the best way to consider lead time is when you go to order from your supplier of your raw materials. You know, the second you know, send that purchase order, you know, if you hit enter or you do the phone call, that's the day that it starts. And then the day that it comes and eventually hits your dock, that's your end day. So your lead time is pretty much the time between, you know, picking up the phone call and the product winding up on your dock. And so that's what that particular item means. And then you add in your safety stock. So all these together will tell you, hey, this is when I need to make sure I get my inventory ordered. And the key thing in here is you have to have a budget together. Now, if you're a mature company and you've been around for 20, 30 years, you probably know how your cycles go, or if you're a cyclical company, and you know how often or what you sell in particular October or November type situation. So you could probably get by without having a firm budget in there, to be able to develop your order point. But if you're not a mature company, you have to have a budget in place as to how many units you plan on selling, because you've got to have this in place for that. Another thing to keep in mind when you're looking at this particular formula, and in particular lead time, is a lot of people will order outside the US for their products, whether they go to Switzerland because of the particular aspects on consumable products from Switzerland, or China for whatever various materials. There is a lead time there that is going to add in, or there's additional days that get added into that. So you have to be cognizant of that in your formula. Is if your main supplier, let's say, is in China, and you're doing orders from them, it could be upwards of 100 days from ordering from them for them to when that product gets on the boat, ships across the sea, gets to the respective dock or gets to the respective port, then it gets to your warehouse. It could be upwards of 100 days. So you need to make sure that's built in. The other thing you need to keep in mind is, especially if you're ordering outside the US, is what are the national holidays in those particular countries. For instance, for those of you who order your products out of China, you're fully aware of Chinese New Year. And just for those of you who aren't aware, during Chinese New Year, almost the entire country shuts down. So from approximately early January to early February, and I'm just uh, being general here, you don't get any orders done. And so if you've done your calculation, you have your standard calculation, and you need them to get you the order, it has to be in by January 31st. Well, the odds are is that might not happen because of that. And so you need to be able to plan not only just your normal lead time, but what other aspects in those other countries, if you're going outside the US, impacts how much or how much additional lead time you're going to need. So you got to keep that in mind on that. So we have a question here. How do I determine the right amount of safety stock and set an appropriate order number? Well, on safety stock, and again, this kind of safety stock is kind of like the first formula that you have to do. Think back to your algebra class. Safety stock really is taking your maximum daily usage, so the best case scenario of how many products you're selling per day, times the maximum lead time. So that is kind of the most sales and the longest lead time. Multiply those two numbers together, then subtract out your average daily usage minus your average, or times your average lead time. So you take those two formulas, multiply them each other, and then subtract, and that will pretty much get you your safety stock. Now, again, you may want to round because it's never going to be exact, but that kind of gives you an idea as to how to do the safety stock. Again, it takes kind of best case scenario on sales. We're rocking and rolling sales, but then we've got the worst case scenario, and it takes forever for the other product to come in. So that kind of gives you that wiggle room on your safety stock. And then the other question is, what formulas or rules of thumb should I use for small businesses? You really want to do the same thing. You need to have a budget in place, because you can't do an order point going forward if you don't know really what you need, because on that order point, it's using average daily usage. But if you're a company that you sell 30, 40% of your total revenue comes in the last quarter of the year, well, obviously you're going to need a heck of a lot more inventory in before then. And if you have, say, a 100-day lead time, you probably need to have that inventory ordered no later than, say, May or June, just to make sure it gets in time to be able to order through. So you want to use the same formulas, regardless of your business size, but you also need to make sure you account for, are you cyclical, are you not, are you linear? What are the different aspects within your business? So next item in cost of goods sold is direct labor. That is really wages and benefits of the employees directly involved in production. And again, this includes assemblers, machine operators, bakers, etc. This excludes people in administrative, sales, indirect roles. This is just the people that are physically, an easy way to think about it is physically touching the product or touching the material to get to the product. They are directly involved in that. One key that some companies forget is if you look at that first line item where we talk about wages and benefits, it's the benefit part that sometimes catches people off guard. So if Joe makes 20 bucks an hour and he's working on the line, a lot of times you'll see companies take $20 an hour times however many hours it took to build it, and then they consider that direct labor. Well, even though you're paying Joe $20, you still have to pay FICA, insurance, et cetera, et cetera. Those are all the benefits. And a lot of times what you'll hear in the CFO world is we tend to call that burden. And so you need to be able to have not only the wage, but the burden built in. And a very general rule of thumb is 21 to 23% kind of gets you to that burden rate. And so even though Joe may be making $20 an hour, after you factor in the burden of, let's just say, for simplicity, let's say it's 20%, technically it's $24 an hour of direct labor going into that product. So that's kind of the key in the direct labor area is not only the wage, but the benefits on that. But usually we consider that to be called burden. And we've got a question here. How do I separate direct labor from indirect labor or administrative salaries? So again, you need to make sure you have obviously a tracking mechanism. If you have people that are working out in the manufacturing plant, that's where their salaries are, that's where they should be tracked. And then if you have indirect labor, which is usually going to be your administrations, your plant supervisor, manager, they're involved with everything, but they're not directly touching every product run type situation. So you've got to have that there. A lot of times what I've seen or what our company has seen is in the respective payroll, whether you use ADP or any other third-party payroll, usually they will break out departments for their respective employees. So like Department 30 could be all the employees that are physically in the plant. Department 40 maybe the administrator or the supervisors and plant managers. And then 50 could be your admin people. And so then you're able to actually break it out. So if you have all your employees in Department 30, you immediately know this is all direct labor. They're directly working on products. 40 is going to be an overhead cost. They're working on the products, but not directly on each individual product. So usually that's how we've seen it is one, you set up a code within your payroll software to say here, Department 30 is all direct labor, Department 40 is indirect labor, et cetera, et cetera. So that tends to make it a little bit easier on that if you don't have a very sophisticated tracking mechanism. We'll go through that here in just one second. So overhead. Now this is the area again, remember at the earlier slide where we talked about that one particular company that they didn't include overhead. Overhead tends to get missed a lot. It's not uncommon for a lot of companies to not properly include overhead into their cost of goods sold. So what is overhead? By definition, it's really indirect costs associated with the production. And again, common items, factory rent, utilities, indirect labor, supervisor, maintenance. So it's really all the costs that are necessary to make the product, but can't be directly, taken or associated with that, product run of, widget A or widget B. Another way to think about it is in your physical plant, you've got the lights turned on. Well, if you weren't making that particular product, the lights wouldn't be turned on. You wouldn't be incurring that energy. The machines are running and you're moving the product down through the, doing those various machining. The electricity for those machines, that's technically part of building that product. However, you can't say, okay, here's my electric bill for the month, it's $10,000, and I know exactly $8,342 is related to the product runs, and it goes to each of these products. That you don't have that level of sophistication, nor do you really need it that. But that's kind of what overhead really is looking at all those costs that are really associated with producing the product, but you can't directly say this is exactly to that. And again, another item in there, you look at maintenance. So a lot of times, especially if you have a larger plant, you probably have, 1, 2, 3 people in maintenance that literally that's their job, is going around making sure that machines run, fixing down machines, etc. Well, they are part of keeping that product moving, so they are a cost of the goods sold, but you can't allocate their salaries to each individual product in there. So again, it's important that you have overhead built or understand what your overhead is and get it built into your cost of goods sold. Question here, there's 2 questions. First question, probably have to do that offline. But the second question, what is the best method to allocate overhead fairly? Now, there are various methods to allocate overhead, and it really is going to be dependent on how accurate you're able to track numbers, such as takt time on the machines. Ideally, or I shouldn't say ideally, most of the time people use direct labor as kind of the method to allocate their overhead. So in other words, they'll take, if it took 20 hours to build this particular product, then they'll allocate, 20 hours of overhead rate to that product. Now, next question you're going to ask is, how do I get my overhead rate? Usually the best way to get your overhead rate is you look at last year and you say, okay, what are all my overhead costs from last year? And then what was my total direct labor hours? Divide those hours, and that is for the entire year. So let's say it's, for 2024, we had, X amount of total overhead costs, and this included the rent, utilities, everything. And then, let's say you had 1,000 direct labor hours. And so take that 1,000 hours into that overhead costs, and then that gets you kind of your overhead rate. So then going forward in 2025, you'll use that rate and allocate it based off of labor hours, if you're using labor hours as your respective allocation. Now you can use other aspects such as machine hours, but you have to have a tracking mechanisms in place to be able to do that. So a lot of times people just go to direct labor because it's the one that they can track. But again, back to overhead. So we've figured out what our overhead rate is. We're now in the current year, and we're using that rate times direct labor hours. Usually what's going to happen is as you start going through the year, so you're in January, February, March, you're allocating those costs. Eventually, you're going to get to a point where you're over allocated overhead or under allocated. Because keep in mind, we're setting a rate based off of something that happened in 2024. And so that's why it's important you track what you've allocated to make sure you don't get too far out of balance. And, again, it's not uncommon that you're over allocated in one month and then you're under allocated in the next month. As long as they, for the most part, net out and smooth out as you go through, you're okay. But you want to track to make sure you don't get too far out of whack, whether it's over allocated or under allocated, because that will mess up your cost of goods sold in 2 years. And what I mean by that is, if you're over allocated, your cost of goods sold is going to be lower in the current year, assuming your inventory sits there. And then that means you're going to have a higher gross margin, higher gross profit, everything looks great. And then the next year, when all those costs that got over allocated then are released into the income statement, then all of a sudden you have lower. And so that's why you want to track that. And one of the things you want to do is with your overhead costs in your general ledger, you want to make sure all your overhead costs are in one section, whether it's by account or you grouped them into a section so that you have every single overhead cost. And under true theory of cost accounting, your overhead that gets allocated will show up as a contra. So theoretically, if everything worked properly, you'd have all your overhead costs, your overhead allocated, everything then goes to zero. That doesn't happen. I don't know specifically on your large companies like General Motors, but my gut is no company ever actually hits zero, but you want to be pretty darn close to it. And so that's what I'm saying is you're over under allocated is looking at those numbers to say, am I getting too far out of whack? And a lot of times it takes 3 or 4 months as you go through that. So next item, break-even analysis. Now, all this kind of gets us back to, we want to make sure we're at least not losing money on everything. And so you have to do a break-even analysis. Now, the very simple formula, if you're going to use, well, first I should say, break-even really is total sales minus total cost equals zero. So in other words, your net income for the year is zero. That would be a true break even. All your sales covered all your costs. You don't have anything, you didn't come in negative, nor did you have extra. You truly broke even. And so that is really what break even means. Now, a very simplistic formula is break-even units equals fixed cost divided by price minus unit cost. And again, that seems very complicated. And once you have those numbers broken out, it's not overtly complicated. But the problem with that formula, and we're going to show you an alternative way that we use with our respective clients. The problem with that formula is if you have a brand new product, it's really hard to be able to do this, particular formula, especially it's a brand new product, you're launching it. You don't really know what your break even is because you don't have any sales yet. You don't really know what fixed cost allocate to it. And so it gets very, very complicated on that. So an alternative method that we do for our customers or our clients is we do a calculation based off of a percent. So first, what we do is we'll calculate the operating expenses as a percent of sales. So remember our kind of basic formula for the income statement. You have sales minus cost of goods sold equals gross margin. Then everything below that is operating expenses. We're going to assume we don't have any odd other expenses. So everything is operating expense. So you want to calculate what that percent is of total sales. And when you do this calculation, you want to do more than 1 month. Don't just do 1 month because that will get you skewed all over the place. So make sure you at least have a quarter, preferably more data so that you kind of more or less you're going to average it out and smooth it out. So now we know that we want to do that operating expense as a sales as a percent. What that tells us is that is the percent that we have to have in our gross margin percent to be able to break even. So in other words, the reason why this is beneficial is that gives us an understanding of this is my break even percent on the company as a whole, and kind of the barometer you use on your individual products. So let's go into a quick example on this. So let's assume we have $1 million in sales and our operating expenses, again, we have sales minus cost of goods sold equals gross margin, and then we have operating expenses below that. So our operating expenses is 200,000. So based on this formula, our operating expenses as a percent of sales is 20%. So what that tells us is that for this particular company, our gross margin percent has got to be 20% or higher for us to break even and or make money on the respective company. And the way to think about that is, let's say our gross margin is 200,000. So if we just look at simplistic numbers, if our gross margin is 200,000 and we minus out our operating expenses of 200,000, we're going to be at zero, which is break even. And again, if we look at gross margin 200,000, that then is 20% of the respective sales, and that's our gross margin percent. So the reason why that's hugely beneficial is if you have a bunch of different products, and they all have different little processes on being produced, some similar, some not. You need to be able to do an analysis of your margin on your individual products and an analysis on the company as a whole. So if you have this percent, that at least gives you kind of an understanding of here's kind of the floor on this particular, if we have a new product, here's the floor. We have to be at 20%. Well, here are our cost of goods sold. So that means our sales price has got to be X. Now, that isn't just a stand all in stone, everything must be, in this case, 20%. You can technically have products below that, but you have to have an understanding that, okay, if we're going to sell this particular widget B and it's got a 15% margin, that just means we as a company have to sell a lot more than we normally would to ultimately break even. So if you think about kind of the formula again, our operating expenses divided by sales, let's assume the operating expenses stayed at 200,000. and our gross margin is at 15% currently, well, then that means we have to have a lot more sales, so then more or less dilute the percent of operating expenses to sales. So a lot of convoluted stuff, but if you see it on paper, it starts to make sense. So if you do have a margin on a particular product that's lower than your break-even percent, you have to have the understanding that either one, you have to sell a lot more, i.e. make it up on volume, or you need to understand that you might not want to sell that particular product, or I guess a third option is that product's going to combine with a high margin item, and the net of those two is still above 20%. So, but again, this percentage helps you understand, and the way you can make your margin percent lower is to have better cost of goods sold, or better calculation of cost of goods sold. The other benefit of this formula, let's say you have some overhead costs that should be in cost of goods sold, but you don't have it there. This formula technically will account for it. So let's say you have $100,000 in overhead that really should be in your cost of goods sold. In the same example. So our operating expenses are now 300,000 versus 200,000. So that means our break-even percent is 30%. So if we kind of walk through the other side, our margin, if our margin originally is 20%, but we just took out 100,000 out of cost of goods sold, that means we just bumped up our gross margin percent, and hopefully that gross margin percent is at 30% or higher. So even though you may have costs in the wrong bucket, which is not uncommon, if you're doing this particular formula, it more or less accounts for it. It just means that, hey, your operating expenses are going to be higher as a percent of total sales. So that just means your margin has to be higher. And so you kind of get back to the same spot. And so that's the other benefit of doing this particular calculation. It kind of gives you that wiggle room in case you do have items in the wrong particular bucket. If I got a question here, if my material or labor costs increase, how much more do I need to sell to break even? I'll follow up with you on offline, but just generally, it's if you're increasing your cost of goods sold and you're not increasing your sales, that just means proportionally you're going to have to increase it, depending on the product, what your particular break even is, et cetera, et cetera. So that's something we'll have to show you online. And one thing for the general audience you should consider is in Excel, there's a slider bar function, and you can build a slider bar function into your actual formulas. It's just kind of simplistic Excel formula, where you start, moving back and forth saying, okay, what happens if this product is below 20%? Okay, well then how do I get to break even? And then you can make it do the calculations. Now, a lot of YouTube videos on that. So I suggest if you're not Excel savvy, you watch all those videos first and then do a test run, where you actually you calculate the answer outside of it, make sure it works. But in other words, you audit that formula. And if you get that, then that makes your life a little bit easier if you do run into this situation. Okay, my labor and material costs have gone up. How do I account for that? So, and that's very a simplistic way. Now there's other sophisticated ERP software out there that will do that calculation. This is just in general how to do it with just using Excel. Now, the main takeaways: know all the elements in your cost of goods sold. Make sure you track and manage your material, labor, overhead, and inventory closely. And again, looking at your safety stock and your order points. And then use your cost of goods sold to make informed pricing and your break-even planning. Now, let's jump into, we've gone a little bit over, but we're going to see if we can knock out at least a couple questions here. Are software subscriptions or office rent considered part of cost of goods sold or overhead? Where do digital and recurring costs fit in the calculation? So again, it depends on what the software is for. So if you have, say you're using one of the ERP software to do your calculation, to do your inventory, to do your bill of material, your BOM reports, all that process, that would technically be an overhead cost because it's really associated with building that particular product. Now, if it's a QuickBooks subscription, that's an admin cost. That's not really part of building materials. you can have any other costs really over there that doesn't really impact how the product gets built. But if you got ECI or one of those ERP softwares out there that it has the calculation on the BOM and everything, that's predominantly going to be used for doing the production. Now, the accountants will jump into the respective BOM software, but that's because we're doing cost accounting, and sometimes we're auditing the formulas to make sure the proper materials are being released. But for the most part, that would technically be part of it. And then the other part of that question, office rent. So many times what we've seen is you have rent of a facility, and the facility is physically broken up between, here's the plant, big wall, here's the admin offices where your salespeople, your accountants, etc. sit. Now the rent is usually for the entire building. And so technically part of that rent is going to be overhead and part of that rent is going to be for the admin side. And so you just need to make sure you have some sort of logical calculation, whether you're doing square feet, which is kind of the more common way, or usable space, et cetera, et cetera. There's other aspects in it. So rent technically would be part of overhead, which then obviously would be in cost of goods sold, assuming the rent is for the entire building. Now, if it's office rent and it's just for the admin part and it's not for the physical plant part, then that would just be admin. That wouldn't be part of your overhead. And what are the most common mistakes businesses make when calculating cost of goods sold, and how can I avoid them? Well, the most common mistake is not understanding that overhead should be part of your cost of goods sold. It's easy to be able to see, here's the materials, yes, the physical materials, here's the labor. Now, obviously, a lot of times the burden on that particular labor doesn't get brought in, but it's really the other overhead parts. Because if you're building that particular product, you're using the electricity from the machines, you're using, you're paying for the insurance, all that items to cover that plant. That really is part of the cost that you need to build into that. Now, if you're not building it into it, then you need to do that break-even percent that we just discussed on operating expenses as sales. You need to do that calculation so that you can at least account for it and understand that, that just means your operating expenses of sales is going to be a higher percent. But most of the time, the common mistake I see in calculating cost of goods sold is not bringing an overhead in there. And then the other aspect to that is over allocating overhead or under allocating. So even though you're calculating overhead into your respective cost of goods sold, you still need to make sure your allocation is proper. You're not over allocating or under allocating. Because keep in mind, if you over allocate, that means you're more or less putting a credit into the income statement. Credit is a sales calculate or a part of the sale. All your sales are credits. And so if you're over allocating, you're putting a credit. So you're making quote revenue onto your respective income statement. And so that's why you want to keep an eye on that, because the overhead rate you set up for 2024 may still be okay for 2025, but it may all of a sudden you have a significant increase in rent and insurance. Electricity rates have gone up, and so that overhead rate might not be proper anymore, or it could be converse. All of a sudden you have rebates on electricity and all that. So make sure you're keeping an eye on that. Usually what we've done is about once a quarter, we'll look at the over-under allocations. You can't just do month to month unless it's way out of whack, because theoretically or hopefully it just zeroes itself or smooths itself out the following month. A lot of times, sometimes that over-under allocation happens because of accruals and timings of that. So that is today's webinar. I want to thank you for taking the time to listen about cost of goods sold. Again, my name is Steve Hovland. I'm the founder of Delegate CFO, and you can reach me at steve@delegatecfo.com. And if you want, you can go to our website, delegatecfo.com, to learn more about our respective company. And the recording and materials of this particular webinar will be sent out shortly. And again, if you're watching this on replay and you would like copies of the slides, just let us know, and we'll try to get that to you as quickly and timely as we possibly can. And again, I want to thank everybody for attending this webinar. And again, if you have any questions outside of this webinar that are formula specific, please don't hesitate to email us and we'll try to get back to you in a timely fashion. Again, thank you and have a great day.